Welcome to Hive Conversations with Bilal, Hafeez. Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com.
Hello, Bilal. So welcome for another edition of our podcast show, where finally you are the guest this time. So very welcome. And I would like to start because actually I don't know what is your how everything started. So where did you study? Did you end up in finance because you wanted to end up in finance or just by chance? So just let us know a bit of the where everything has started.
That's great. Thanks for that, Antonio. And it's I feel a bit nervous being the guest. I'm normally the host, and I can sit back and just ask other people questions. So I appreciate you taking this on to ask me questions. Yeah. So in terms of my origin story, I mean, even before university, let me start by saying that my background before university was that I grew up in Oxford, which was obviously a big university town, but I didn't necessarily come from a very well-off family. So my parents originally, they're from Asia, so they came over in the 1960s to the UK, working class family, immigrant family. And so, I went to a kind of a regular state school. It wasn't particularly good, but my parents were very, very focused on us doing well academically. So my mother in particular, my late mother, who unfortunately passed away a number of years ago, she was very insistent on us doing extra work when we came home. So every day, me and my siblings would come home, would be allowed to watch 1 hour of TV or something. And then after that, we'd have to do maths homework. It couldn't be anything else, couldn't be English, couldn't be art. It had to be maths, which is a very kind of Asian mentality there. So, I do owe a lot to them. And they instilled in me this idea that in the end, you have to find your own way to support yourself financially. And also you have to financially support your broader family as well. And so as a drive within myself, I always had this drive to say that, okay, if I go to university, it's a stepping stone to, going on to a job. It wasn't necessarily just a hobby for me to do. Now I did well academically at school, thanks to my parents. And then I got a place at Cambridge, not Oxford, because I did want to have some distance from my parents, although I did love them. It's good to get some distance. And so I did economics at Cambridge. And it was really at Cambridge that I got to understand what people with economics do as professions afterwards. So I was actually fairly open to careers. I was thinking maybe consulting, or maybe banking, even accountancy. These were kind of the normal tracks. And I ended up applying for summer internships at the end of my second year at university. And for whatever reason, I got rejected by all the accountancy firms and all the consulting firms. And it was only the banks that accepted me. So I got a summer internship at JP Morgan. And this was back in 1997. And the work I did there, it was in foreign exchange research, FX research, as it happened. And I was building models, using the latest econometric techniques to predict currency devaluations. And that was during the Asia crisis in 1997. So I was really immersed in all of that. And I really ended up loving that. And after I graduated, I joined JP Morgan, and I started my finance career there. And, so I actually had a brief foray in mergers and acquisitions, which I hated, tech M&A, which was a hot thing at the time. Absolutely hated it. Hours were long. Work was not intellectually that interesting. So I moved back into FX research. And I had a really good mentor early on in my career, a person called Alfonso Prat Guy, who later went on to become the finance minister and central bank governor of Argentina. But he was a really good mentor. And I do think that at the beginning of your career, to some extent, your path is set by your early mentor, because they kind of give you the confidence, they give you a template of how you can be as a person, how you can be as a professional as well. And he was a really good, fundamentally good person. He really nurtured me, gave me a lot of confidence in myself, and set me on my track in research. So I spent about 4 or 5 years at JP Morgan. Then Chase Manhattan took over JP Morgan. So there was a merger, and it wasn't, mergers can be quite messy. And so I ended up leaving to join Deutsche Bank. And it was at Deutsche Bank that I ended up having kind of a long career. I spent 13 years there. where initially I was in foreign exchange research, and I did a lot of interesting work on building models using different sort of techniques and such. And I built probably some of the earliest smart beta, what's now called smart beta models in currency markets in the early 2000s, FX carry, FX momentum, FX value, which allowed me to move up the hierarchy within Deutsche Bank. Then after the global financial crisis, I then moved out to Asia in Singapore, where I ran various research groups out there. I got to learn a lot about China, spent a lot of time in China there, which was very helpful. Moved back to London, where I had multiple different roles. I set up a group doing multi-asset research. I also was in a unit, leading a unit which was advising the CEO of Deutsche Bank as well. So I got exposure to the highest levels of Deutsche Bank. Then I decided to leave Deutsche Bank to join Nomura for about 3 years, where I ran research at Nomura. But, after spending 25 years on working for big banks, I decided it was time to strike out on my own. And along with my partner, Andrew, and a few others, we set up Hive, where I am now, where we sort of independent body producing research analytics for investors around the world. So that's kind of my story.
So it is fair to say that you spend 23, 24 years in research in
it's
financial
always pretty much continuously in research. I'm a researcher through and through.
Yes, no, that's great. And so we did recently. We saw many clients, and how would you summarize? What are the topics that are most interested at the moment for our clients, and yes, what are your main takeaways with your conversation?
Yeah, so you're right. We were seeing clients recently. The clients of Hive, include some of the smartest hedge funds in the world. Asset managers, some of the largest banks. So it's a nice selection of what the most sophisticated, risk takers in the world are thinking. And perhaps the biggest topic was really around the Fed. So of course, at the end of last year, coming into this year, many people had a very dovish view on the Fed. People were thinking that the Fed will cut rates, March, April, May, June. Early on this year, it'll be start of a proper easing cycle. Fast forward to today and speaking to clients, many were now talking about, is there a chance that the Fed does not cut rates at all this year? So at the moment, the market is pricing, you could say, like 2 cuts roughly towards the end of this year. And the question really was, could we have a scenario where there's no cuts, where the Fed just stays on hold all year? And my take on that is I think there is a real possibility that could happen. Why? Number one, US growth continues to surprise to the upside. So at the start of this year, consensus was looking for US growth over 2024 to be around 1.5%. They've been forced to revise that up to over 2.5%. So, it kind of tells you that US growth is actually doing okay. And if you look back over the last 30 or 40 years, the average US growth rate is just over 2%. So US growth right now is around trend. And if you're at trend growth, that doesn't necessarily mean you need to cut interest rates. That's the first thing. The other thing is, if you look at what's driving this strong US growth, one big factor, I think, has been all the various fiscal programs that have been there to support US growth, in particular, the so-called Inflation Reduction Act, which in reality is really a climate change act, which is really helping investment in the US. Just to give you an example, and it's kind of ironic here, but Texas is seeing a massive increase in solar capacity, in solar production. Probably the biggest increase it's ever seen. And that's driven by subsidies and support from the federal government. So Texas, a nice Republican state, is making full use of a federal program to support this infrastructure build out. And so the fiscal side is very strong in the US. Recently, we had additional defense spending bill announced, which was there to support Ukraine, Israel, and Taiwan. And, although that money is defense to support those foreign countries, that money will go to US companies, in all sorts of different ways. So that's another fiscal stimulus. And of course, the other side is the labor market in the US is very, very strong. Jobless claims is fairly benign. Payrolls has been strong. And so that supports growth overall. So that's one reason. The growth picture is very strong. Then on the inflation side, we do have sticky inflation. towards the end of last year, inflation was falling. This year, inflation numbers have come out, to the top side. And in particular, services inflation is very sticky and elevated. So if, for example, you look at the last 3 months of inflation from looking at the US CPI report, if you annualize the services component, it annualizes at 5 or 6%, which is very, very high. So for all of these reasons, I think this should make the Fed quite cautious in being too early in cutting rates.
Yeah, and anything else, I don't know, about China, Europe that you want to bring up to the discussion?
Yeah, I mean, the thing I wanted to flag to clients, which I think they don't, that they aren't focusing enough on, is the dynamics within China. It's funny, China a few years ago was really a big story in macro, and now it's becoming less and less important. People just don't focus on China as much. But I do think China is very important insofar as what we see in China is that there's this huge supply-demand imbalance. And what I mean by this is that the way China is generating growth is that it's ramping up its production and some of its investment as well. So it's increasing its supply a lot. But then if you look at the demand side of the economy, it's really quite weak. So if you look at retail sales, it's relatively weak. So you end up with a supply-demand imbalance. So they're kind of over this excess supply in China. And that excess supply has to then, end up being exported. Or if it stays in the domestic market, it ends up pushing prices down. And so I think the interesting story about China is that it's exporting deflation to the rest of the world in the goods sector. So China is overproducing stuff, goods. And as a result, it's leading to lower goods inflation around the world. So, for example, in the US, if you look at the most recent inflation numbers, core goods inflation is annualized around minus 1%. Yeah. And so, one of the reasons why, components of inflation are low is that we have this dichotomy. We have low goods inflation, driven, I think, in large part by China. And then you have high services inflation. And I think that's important.
Let me interrupt you 1 second on this, because you said very correctly that so what is going on in China, of course, is not, if anything, is not inflationary from the US. Then we have big immigration. So as we know, there was a lot of immigration, increasing supply of labor, which should not be inflationary. And as you said, you started in 1997. So you have seen already 23 years of economic cycles. So what is your, what do you think, why we keep getting this inflation that is sticky in the US? What is, how do you explain, in your view, why you got this phenomenon?
Yeah, I think there's a couple of reasons why we're seeing it now. And, a large part, we kind of have to recognize that the COVID shock, since then we've seen all of this sticky inflation. And I think what that tells you is there's a few reasons why this has all happened. Number one is that there has been something going on with the supply chain and deglobalization. So, supply chains, nearshoring, onshoring, it's just increasing the cost of everything. On top of that, there is more economic nationalism where everybody is saying, look, we don't want to be reliant on other countries. We want to build stuff, within our own countries, make everything in America, make everything in China, make everything in Europe. So that just introduces additional costs. And people are trying to introduce additional buffers. So that's one kind of reason. Another is that we have much more aggressive fiscal actions than we've ever seen in a long, long time. So the level of the US budget deficit today is the largest it's ever been outside of a recession or outside of a war. And so when you get so much, fiscal stimulus, which goes directly into the real economy, that overstimulates the economy. And then I think the other more subtle point is about the labor market. Now, you talked about, foreign workers have increased, which I think has been very important. But if you think about crises in terms of balance sheets, going back to the global financial crisis, the balance sheet that got destroyed was bank balance sheets, which were destroyed, because of the crisis. And then there was deleveraging after that. And then we saw, secular stagnation for a prolonged period of time. Now, after COVID, what was the balance sheet item? What was the stock in the economy that got hit? And for me, it was labor, it was humans, it was people. People got infected, they suffered from long COVID. And as a result, you've ended up in a labor shortage sort of dynamic that the impaired asset is not bank balance sheets or corporate balance sheets, it's human capital has been impaired. And I think that is something we haven't quite understood properly. And I think that's led to all sorts of funny dynamics in the labor market and in terms of inflation. So, for example, what you're seeing is the number of people who are out of work because of health reasons has increased dramatically. I think that's to do with long COVID. If you look at the sectoral imbalances in the labor market, there's still, while tech companies are laying off lots of tech workers and banks are laying off, bankers, in the service sector, you still see restaurants still need labor, hotels still need labor as well. And so there's something about the sectoral shocks that we've seen that is particularly inflationary. And then the final point I would make is there is something around kind of capitalism itself, where from the Reagan years onwards up until, say, COVID, you could say that capitalism did very well, as in corporate profits were going up, 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 and wages were going down, 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 down as a share of GDP. And I think what COVID has done is that it's realigned things where labor feel like people feel like they have the power to demand higher wages. In Europe, it's through unions. In the US, it's through just increasing minimum wages and so on. So I think all of these factors together have reversed lots of these deflationary forces that I saw during most of my career.
Yeah, thank you. Because as you know, I'm very macro passionate and oriented. And sometimes maybe I look for too many macro reasons for movement in the market. Given that I want to talk about US yield and dollars, I wanted really you to go more in detail on the economic behind the economics behind the US economy. Maybe before we shift to US yield and dollar, which of course you have spent all your career in FX, so everyone wants to hear about your dollar view. But on Europe, do you have anything you would like to share?
Yeah, I mean, I think Europe, if we go kind of big picture, first of all, I think Europe's in a very difficult situation, just from a structural perspective, because if you look at the US, the Biden administration introduced an infrastructure bill, Inflation Reduction Act. There's been a massive government program to upgrade the US infrastructure. China is kind of doing the same as well. Recently, they've announced a big upgrading of capital equipment to make it more green friendly. And Europe has kind of done some stuff, but not much, just because of the nature of Europe is such that it's fragmented. You have EU policy, but then you have national policies. There's all these fiscal rules to stop them from doing anything. So while China and the US have sort of forged ahead with, doing lots of upgrades, Europe has lagged behind. Then on top of that, Europe has an energy problem. Obviously because of the Russia-Ukraine war, it's had to build different energy suppliers. Whereas China has benefited from the Russian war, you could say, by everything being redirected towards China. US is energy independent, so Europe sort of suffers from that. So I think, Europe has a big structural problem. Then on top of that, China now is becoming a massive car exporter to the rest of the world. Whereas before they would import German cars, so that's gone. So Europe doesn't benefit as much from Chinese growth as before. So I think there's a structural problem in Europe that Europe has to deal with. So that's number one. Number two, on the inflation side, you are
thank you. That's great. And
then on the inflation side, you are starting to see some signs of inflation moderating. Now, the ECB in particular does believe that the wage increases that we've been seeing in Europe are starting to come down. And I think that's partly to do with the economy being on the weak side. There's, that sort of Germany's kind of in recessionary territory. On top of that, if you look at credit conditions within Europe, they're very tight. And Europe relies a lot more on bank lending. US companies in the US, it's more reliant on capital markets, where you can get more attractive, borrowing. So I think you do have this interesting divergence that's starting to build up between the US and Europe. Whereas over the past year, they've been moving up and down together.
Yes, I think EI is going to be a team that probably is very interesting and also difficult, I would say, to forecast. So you touched before on the Fed, now that two cut, maybe no cut. It's difficult, but there is that risk. So in general, US yield and dollar, how do you see the dynamic playing on? And what is your view on both US yield and dollar?
Sure. If we on the US yield, let's just focus on the 10-year yield, just to keep things simple. US yields have gone up so far this year. It's trading around 4.6 or percent or so. My sense overall is that we are going to go back up towards 5%. Which is where we got to last year. The reason I say that is that, number one, there is a chance that the market could start to price out some of the cuts that we're seeing. So that in itself could push up yields. But more than that, we should start to see more term premia come back into the curve. So, the long-term interest rates are driven by expectations of monetary policy over the next 10 years, plus some term premia on top of that. Now, term premia in the US, depending which model you use, is close to zero or negative. Back in the 2000s, back in the 1990s, term premia would be around 50 basis points, 100 basis points. So outside of the Fed itself, you could see, almost 100 basis points of term premia come back into the curve. Now, it will take time for that to happen because you still have lots of factors that keep term premia down. One is the Fed's holding of treasuries is still quite large. There's still a lot of collateral demand for treasuries, lots of repo demand for treasuries as well. But nevertheless, the size of the US deficit, the size of US debt means that term premia should sort of pick up. Then the other factor I think that's also quite important is from a narrative perspective, over the last year or two, 10-year yields for large part of the last 2 years has been driven essentially by Fed policy. So when the Fed was hiking, 2-year interest rates and 10-year just moved up together. Then last year, we had a term premia shock, which was around QRA, the quarterly refunding announcement, where the Treasury in the US started to announce more issuance of bonds. So suddenly there was some term premia. And I think maybe the next phase of US yields could perhaps be driven more by inflation expectations starting to pick up. So what's been interesting over the last few years has been how anchored inflation expectations have been in the US. And the markets essentially believe that the Fed is credible in keeping inflation around 2%. And I think now we're in this dangerous zone where the Fed could lose some credibility on that side because we had this ramp up in inflation. Then last year it started to fall, because of the unwind of the supply side issues and the fall in oil prices. But if it moves back up again, so the second peak is where central banks lose credibility. And so I think there's some risk that break-even inflation could pick up, especially in an election year like this year, where the Fed will say, maybe we're happy for a bit of higher inflation in order to keep the US economy growing well, in order to appease the US public. So for all of these reasons, I think we have enough factors that could push US yields higher.
So US yield higher, and where does this leave the dollar?
Yeah, on the dollar, big picture, the big challenge with the dollar is that from a valuation perspective, the dollar is expensive. So if you look at the trade-weighted dollar going back to the 1970s, there's been a few peaks in the dollar. One peak was in 1985, where the dollar was at very high levels. Then the dollar fell for the next 5, 6, 10 years. And then there was another peak around 2000. And today, where the level of the dollar is higher than it was at the 2000 peak, but it's slightly lower than it was in the 1985 peak. So either way, we're close to historical highs. So that's my one kind of concern around making too much of a big bullish view on the dollar because the levels are very high. Outside of the valuation argument, most factors are bullish for the dollar. So the level of US interest rates, especially against something like Japan, where interest rates are still close to zero. US interest rates are higher than the European interest rates. They're higher than Japanese interest rates. They're higher even than Australian interest rates. So carry supports the dollar. If my view is correct on the Fed, and the Fed doesn't necessarily move that much while the ECB cuts rates in the middle of this year, maybe the Bank of England does as well, that's also supportive of the dollar as well. So I think all of these kind of more cyclical factors, I think, are generally supportive of the dollar. So my bias is to be bullish on the dollar. So I look for euro dollar to head down, dollar yen to go up. But because of valuations, I think that you can't have a very strong view about the trend in the dollar. So it's more about trading ranges, being tactical, than it is about saying there's a big trend move in the dollar, just because of the level of the dollar is very, very elevated right now.
So now I want to ask you another question, which is this one. So you are basically forecasting some tightening of financial conditions, so dollar stronger, interest rate should go up. Is it possible that the equity market keeps rallying another year without any major sell-off, or do you think we will get a major sell-off? And in your opinion, when do we get roughly a major sell-off? Which is a very easy question to
Yeah,
answer.
I wish it was the other way around. I could ask you that question. Yeah, I mean, I think in terms of the relationship between interest rates and equities, at one level, you can say high interest rates are bad for equity markets, but I think the more sophisticated answer is the reason for the interest rate rise is important. So if the reason for the interest rate rise is because the US economy is doing well, and maybe even if inflation is high as well, because that means companies have pricing power, then that's generally that's not necessarily bad for equity markets. And that's what we've seen so far this year. It's been an environment where growth expectations have picked up and pricing power has gone up, which is good for US equities. What is bad for US equities is when you get some kind of term premium type dynamic where interest rates are going up not because of better growth prospects, but instead it's going up because of worries about the deficit, worries about inflation volatility, all those sorts of concerns. And that we saw some of that last year. So if that happens, then that's very bad for equities. And I think that could be a real possibility at some point this year. So I think number one, that's a big risk factor. Number two, it is true that if we have this move up in interest rates and it stays high for multiple months or 6 months, that will start to bite into the US economy, and so especially if you get a move up across the whole curve. So it's not just the front end that's very high, because I think one of the reasons why this Fed hiking cycle hasn't been that effective in terms of slowing the economy down is that the market is constantly pricing easings, 3 or 4 months later. And so the rest of the curve has interest rates at relatively benign levels. What you need is interest rates across the whole curve, the 5-year part of the curve, the 10-year part of the curve, to be elevated to affect all parts of the economy, because not everybody borrows at the overnight rate. So I think we are very likely to be in that scenario as this year goes on, and that will really start to bite into demand in the economy. So you see a slowdown in the economic data, and then also that will start to hit earnings as well. So I think as the year goes on, you're going to see more and more pressure on equities because of these forces all weighing on the economy. Now, when will equities have the big correction? I think that will happen when we're very close to a recession. The challenge in calling a recession is that all the normal indicators of a recession since COVID have all been wrong in calling a recession. So normally we look at PMI data, that's been wrong. We look at the yield curve, that's been wrong. So all of the normal cyclical indicators that we've all used have been wrong in calling the recession, for one big reason, which is that COVID led to a sectoral shock on the economy, where the goods sector and the services sector decoupled from each other. In normal historical periods, the goods sector leads the services sector. So when the goods sector goes into recession, then the services rolls over. This time they desynchronize from each other, because of the COVID crisis. So goods is kind of in recession now, you could say, but services is powering ahead. Everyone's still going to restaurants. So what that means is that the best measures of recession are measures to do with services, things like retail sales. But more important than that is really the labor market more generally. So normally, the adage for labor market was it's always a lagging indicator. This time, it's the indicator we have to focus on. So when jobless claims starts to rise sharply, when payroll starts to disappoint, then we start to see the beginnings of a recession, and then equities will have the big move down. When that will happen, I'm not so sure. It's probably next year. It could be this year, but it depends on the rates dynamics for us to really be sure about that.
Now, why I fully agree with you on the dynamic that tightening financial condition is going to slow down demand, and then it's going to create at some point, we don't know exactly when, a recessionary dynamic which will increase unemployment and will likely drop equity quite lower. I have two questions on this. Can AI save the equity market forever, let's say? Um, and second question, how to use AI in financial market. And the reason I'm asking you, because you are quite expert, I think, on AI now, because we are doing a lot of stuff on AI, and you follow very closely. So I think you are one of the best person to ask these two questions on
Yeah,
AI.
sure.
Yes.
Yeah. I mean, the way I think about AI is that there's a lot of hype around AI, number one. And I think that the big beneficiaries of AI at the moment are the hardware companies that are producing chips like Nvidia for everyone's using to test their models for AI, and then some of the big tech companies like Microsoft and so on that are partially own OpenAI and some of the fundamental models that everybody's using. So I think they're the direct beneficiaries. For everybody else, I think last year was kind of general AI hype. I think this year is all about how can you actually use AI genuinely to improve your business. And I think this year will be the big discriminator between the companies that can use it and can't use it, and where the hype converts to reality. And I think there's too much hype right now. And I think a lot of the projections around AI are overdone because people don't really understand how to use it. I think a lot of what's been happening in the AI space are companies are kind of doing things like they're using AI to improve, coding or automate your coding, things like that. But then Microsoft can introduce that as a feature as their Copilot in GitHub, say, So I think a lot of companies think they have a business model, but in reality, the big tech companies can turn them into a feature and their business model goes away. So I think that's the big problem you're finding, I think, in AI. So I think lots of these little use cases, lots of these businesses that think they have a business case are all kind of gone away. Now, in the case of MacroHive, we've been intensively doing a ton of work on AI, especially on language models. And our kind of whole view is that it's no point trying to compete with the big AI companies like OpenAI or Anthropic that create the fundamental large language models. So we're not going to say we're going to train our own model that's going to be better than OpenAI's model. Some financial services companies have tried to do that. And what they found is that as soon as ChatGPT upgrades, when they went from ChatGPT version 3.5 to 4, they outperformed all those financial services' own large language models. Now, what we've worked out is the real edge you have in building something that's useful for clients is to use your domain expertise. So in our team, we have world-class researchers in our team with decades of experience who know the intricacies of financial markets really, really well. We have clients who are the top investors in the world, so we understand what our clients need really, really well. So we have massive domain expertise. And so our whole thing is, how do you combine domain expertise with AI to come up with a unique offering for our client base? And so our view and what we're working on is using the best of the large language models that are out there. So ChatGPT 4, Claude, Gemini from Google, Llama from Meta. Use all of those as your starting point. So you take full advantage of all the firepower that they're bringing into the large language models. But then what we do is we bolt on an additional element to it where we have our own knowledge base. So we all of the research we produce as a company goes into, you could call a database, or in this case, what we call a vector database. We add in all sorts of other trusted sources, IMF, World Bank, Bank of England, Fed. And so it's highly curated, highly specialized, BIS as well. We throw in all of our analytics. So we have all sorts of analytics looking at market correlations, carry models, PCA models, and all of those sorts of things. And then we combine that all together. And our aim is to end up producing a hyper-personalized ChatGPT, you could say, for our client base based on what they specifically need. So, for example, if we have a client who trades European rates and they have a short-term horizon, we'll deliver a chat hyper-personalized macro Hive GPT that knows what they are, which is euro rates, and when they ask questions, all the questions will be perfectly aligned to what they are. And another way of looking at this is, in essence, what we're doing is we're building AI agents which will provide kind of not quite a replacement, but an additional type of researcher where you could say, look, I need a South Africa economist AI. So our engine would be able to create that because we have the South Africa knowledge base, South Africa analytics. And so you could say, click on, okay, South Africa economist AI. And then you can start asking it questions and it will come out with answers, for you, anything to do with South Africa. So that's what we're working on. Super exciting. And from a client perspective, the reason we're doing it this way is that one of the biggest problems our clients find, interestingly, is not necessarily give me an insight, that will make me money. Of course, they want that. But the biggest problem they have is a problem of relevance, that they're inundated with way too much information and they just need somebody to help them navigate all of this.
Yeah.
And my take is that large language models are really well positioned to solve that problem. But it only works if you combine it with domain expertise. So that's one super exciting area where I think AI can make a big difference. But it only works if you combine domain expertise with a really sophisticated understanding of LLMs. And to get a bit technical here, the particular approach we're using is to combine graph theory, so knowledge graphs, with RAG, retrieval augmented generation, with LLMs together. And that combination allows us to kind of deliver this type of product.
Great. So I believe that managing macro Hive is taking a lot of your time, right? But in your free time, you will have, I think, still some time to read some book, watch some TV shows, and so on. So on a more soft note, yes, give us your recommendation in terms of books, TV shows. Where do you like to spend a little bit of your free time, if you have any?
Sure. I make sure I do have free time. I've got kids, and so that's even more important than work is spending time with the kids. I do love reading and I do love watching TV shows. So in terms of, let me start with books. Recently, on the books, I tend to kind of go a bit off-piste. I'm a bit different from most other people. I tend not to read the latest bestsellers and all of those sorts of things. So I'd recommend 3 books I've been reading recently. One is actually a book that actually did quite well on the bestseller list, a book called Yellowface by Rebecca Kuang, which is about an Asian American writer who's struggling from writer's block. And she has a very successful friend who's a writer. And she's in the room when that successful writer friend dies. And this writer ends up stealing her draft of her latest novel. And she ends up becoming super successful off the back of this. And it's basically about what happens when you steal somebody else's novel, pretend it's yours, and the consequences of that. So that's a really fun book. It tells you a lot about the creative industry, but it also talks a lot about how minorities in America, live. Another book I'd like is a book called Bruce Lee, Artist of Life. I'm a big fan of Bruce Lee. Bruce Lee, of course, is known for being a great actor, great martial artist, but there's a period in his life, I think, where he suffered a back injury. So he was stuck in hospital or stuck in a bed for about 6 months where he couldn't do his martial arts. So during that time, he basically started to write down his thoughts about the meaning of life and his philosophy. And this book collects together his thoughts on life. And he's a surprisingly deep person. It's in that book where he talks about be like water, which is like his philosophy of life. You have to be like water. So when something gets thrown at you, you don't resist it. You're like water, and you kind of adapt to it all and not to overthink things, and just to accept reality as it is without necessarily imposing your own view first, which creates tension. So that's another book I really enjoyed. You can dip in and out of it. And then another book is a collection of poems by Rumi. So Rumi is this 13th century poet who lived in Turkey back in the 1200s, and he's famous for, his very deep kind of love poetry, you could say. And this collection I'm reading at the moment is a book called Love is a Stranger. It was published in 1990. It's a collection of his poems, and they're really powerful. You can just, one-page poems. You read it; it's very deep, and you learn a lot. So those are the book recommendations. I'd urge people to read. I recommend them all. A bit, they're all kind of deep in their own ways.
Yeah.
Then on the TV side, a couple of shows. I'd recommend 3 TV shows. One is Shogun, which is on Disney Plus at the moment. Really well done show. It's based on the James Clavell novel Shogun, which was a bestseller in 1970s. The premise of the book is this European pirate, you could say, turns up to Japan during the Shogun era, and then gets involved in all the intrigue of one shogunate family trying to take over the shogun, shogun title. So it's different factions trying to vie for power. But this one, the cinematography is amazing. It's really well done in terms of the drama of it all. The action is subdued, but done in a very sort of subtle way. It's probably one of the best shows I've seen, of late. So it's a sort of period drama based in Japan, samurai time, shogun, and all of those sorts of things. Great show. A related period show is an anime on Netflix called The Blue-Eyed Samurai, which is more of an action sort of anime. And that's about a samurai who's actually, it's a woman pretending to be a male samurai, and it's about kind of journey through fighting lots of different sort of people along the way, and some romance stuff in there. It's a really, really good show, and it's on Netflix. And the final one, which is on Amazon Prime, is Mr. and Mrs. Smith, which is kind of loosely based on the Angelina Jolie and Brad Pitt film from the 2000s, where you, in essence, have 2 people who are put together who are kind of secret agents, and then they basically are forced to pretend to be a couple. Really, really good show. Again, great cinematography, and I'd recommend people to watch that as well.
What about sport? Do you have any favorite sport? Anything you like in particular?
Yeah, sure. I'm a big football fan, and so I'm probably going to lose a lot of audience now by saying I'm a Liverpool fan, and so love football. I keep up with it all the time. It's a very exciting season this season in the Premier League, because Liverpool, Arsenal, and Manchester City are really close at the top of the Premier League. We'll see who wins. And of course, this is the final season for Jurgen Klopp, who's done really, really well for Liverpool. So probably football is my big one, but I do also follow tennis as well. And we have the Olympics this year, which I look forward to as well.
Now, while I think you are quite well known, there can be some people still that do not know you. So what is the best way to reach out to you, Bilal?
Great. Well, first of all, just come to the MacroHive website, so macrohive.com. You can read some of my content there, and there's some contact me details there. Otherwise, you can follow me on LinkedIn and also on Twitter. I don't post a huge amount, but I post fairly regularly, so you can reach out to me. I'm fairly accessible. So you just go to macrohive.com. So
it was really great to talk to you. I also discovered a few things that I didn't know. For example, on your career path, beginning of studies and so on. I didn't know about that. So that's great also for me to learn. And so many thanks. Great insight today. And I wish you a great evening.
Great. No, thanks, Antonio. You're a great interviewer.
Yeah, I did my best. Okay.
Great. Thanks a lot.
Thank you. See you. Bye-bye.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.